Hello all, and welcome back to the Central Arizona VITA Network 2021 VITA training sessions. In this segment, we're going to finish our discussion on adjustments and then move into deductions and begin credits. So let's get going.
A taxpayer cannot treat insurance premiums as a qualified medical expense unless, here's the exception, if it's long-term care insurance or it's healthcare continuation coverage, like COBRA, where you've left one job with insurance and you had to leave that insurance, you can use COBRA until you get your next job and pick up employer insurance. But there's a limitation on how many months that's good for. You cannot treat the insurance premiums for these conditions unless healthcare coverage while receiving unemployment compensation. Oh, we have a lot of people right now receiving unemployment compensation, so we might see this. And Medicare and other healthcare coverage if the taxpayer was 65 or older. Qualified medical expenses are those incurred by the taxpayer and the spouse and all the dependents claimed on the tax return. Now, if your Uncle Joe is living with you because he's moved out of his house, maybe he was homeless, I don't know, but he's not on your tax return, then his expenses, he can't use your HSA. That's not a qualified medical expense, only for the taxpayer, spouse, and dependents. The nice thing here is that the child of parents who are divorced, separated, or living apart for the last 6 months of the calendar year is treated as the dependent of both parents for medical expenses. So if one of the parents has an HSA, then that child has access to the medical cost covered under that HSA, no matter which parent it is. And we talked a little bit earlier, a couple slides ago, that generally the expenses are those things that you would find on itemized deductions under 1040 Schedule A. However, if you're doing this, you're taking the adjustments to income through an HSA, you can't claim them as an itemized deduction. That's called double dipping, and that's not allowed. So if the medical expenses have been paid from your HSA funds, you're not going to itemize those deductions. Excess contributions. So you gave $5,000 instead of $3,650. They're subject to a 6% tax. And if they're not withdrawn in a timely fashion, they're out of scope. And in that case, we send them to a professional tax preparer. I have yet to find that. Most everybody is not putting in their max. They're putting in a few $100s every year. And so I haven't run across this at all. Now, here you'll see this is a form comes straight out of your 4012, and it's showing you the screen for adjustments in TaxSlayer. So the health savings account form, and it talks about where to begin filling that out. And then they've even got in your 4012 a screening worksheet to walk you through step by step. And then they show you in the 4012 the screens from TaxSlayer that you would actually enter the information in. So in here, you'll include the contributions, but you're not going to include any employer contributions because that will automatically be added. You're going to put down here the number of months during the tax year that you were selected, and most everybody gets the 12. A few times I've seen somebody with less than that. And then on the next screen, you keep on going down, and we go through contributions, and then we go through deductions, distributions, and we plug those numbers in. There's even a box down here at the bottom for catch-up amounts, but it's pretty much just flowing down the screen, filling in the boxes as you go, the information from your 5498 and your 1099 forms for contributions and distributions. This is kind of key. If you wind up with distributions that are taken out for reasons other than a qualified medical expense, that amount gets included in income, and it's put on line 8 of form 10, the 1040 form. Actually, I think it's on Schedule 1, but it's kind of sticking in my mind that it's on Schedule 1. In other words, you've got money in that account to be used for medical expenses, but you used it for something else, then you're going to have to pay income on it. If you have to pay income on it, it's a 20% additional tax unless one of these conditions occurs. The beneficiary died, became disabled, or turned age 65. Now, we don't worry about excess contributions that are not withdrawn in a timely fashion. We don't worry about HSA funding distributions from an IRA. If the spouse is not the designated beneficiary, we don't worry about that. We don't worry about the additional tax for failure to maintain a high deductible health plan. These are all out of scopes. We do a simple HSA. You put money in, you took money out, and the money you put in was underneath the limit, and the money you took out was all for acceptable medical expenses. We don't take out anything for Archer Medical, Medicare Advantage, or health reimbursement arrangements. And that Form 5889 Part 3, I forgot what Part 3 is. We deal with Parts 1 and 2, which are the distributions and contributions amounts. But Part 3, I think, I've forgotten what it deals with. Now,
probably, I think excess contributions and things like that.
Maybe that's it.
Yeah.
So that's just a catch-all way of saying all this other stuff that we've already listed as out of scope is found on this part of the form.
And I was also going to suggest to everybody too, and I think that's Form 8889. I'm not sure, but I think that's the form number. But so your test is going to ask you, well, hey, how much can you deduct as contributions on Form 8889 Part 2? And you're going to say, what's that? I mean, so when you see a question like that, I told you earlier about using a resource of Google. If you're not sure what Part 2 or whatever that is, Google Form 8889, it'll come right up as a PDF, and you can look at Part 2 and see exactly what they're talking about. So just another trick of taking the test that I would tell you about.
Okay, so this is kind of the summation, I think. We're back to just a reminder. We've taken all this total income. We've now adjusted the income, and we're down to the adjusted gross income. And adjustments to income are considered above the line is the terminology that's used. And that federal adjusted gross income, that's where Arizona starts with the adjusted gross income on your federal return. So let me recap real quick. We've done a lot so far today. We started with retirement income. Jim covered Social Security. He covered Roth and IRAs and 403Bs and 401Ks. He covered early distribution and the early distribution penalties. And most importantly, he covered the simplified method. The simplified method is where our clients come in and the pension statement, the 1099-R, says they haven't determined the taxable income. If we can't help them, the total amount of that distribution becomes taxable. So if we can use the simplified method, if all the pieces of information are available to us on that 1099-R form, then we can use the TaxSlayer software and calculate a lower amount, a smaller amount that is taxable. But if some piece is missing, we're out of luck. Then under capital income, I covered sale of stocks, sale of home, the K1 earnings, the simple stuff that we do. There's no expenses involved. It might just be royalties. We covered unemployment income, and we showed you the form that Arizona uses for that. And then we ended up covering under income, we covered alimony. Alimony is income prior to 2019, and we will see less and less of that as our clientele become older and we get farther and farther away from that dividing line of 2019. But under alimony, that was also the first thing that we covered under adjustments, because under adjustments, we had to deal with what do we do with alimony. In some cases, prior to 2019, alimony became an adjustment to income. And then we went on and covered educator adjustments, then that early withdrawal penalty for my 1099 INT. And we did student loan interest deduction as an adjustment. And we just finished up with health savings accounts. So we've covered 4 major adjustments that lower the gross income down to the adjusted gross income. And now this afternoon, Jim's going to start with itemized deductions, because we've now got to the point of adjusted gross income. Now we're going to cover those things that might lower the amount of adjusted gross income down to a level that would be the taxable income. And that's where we're going to turn it over to Jim.
And before I get into that, Gene shared, and I put a copy, we put a copy in the chat thing of out of scope situations for VITA programs. Now, this is not complete, all of them. Like I said, the complete one is in the 4012, but it's kind of hard to read that sometimes. You got to know what form you're looking at. And most of us partners, we really try to identify the important kinds of things here. And so Gene says that at their sites, they put this right up at the greeters table. So right when we're going through their stuff, if we identify why their return might be out of scope, we can show them right there. And the sooner you tell them, the better. You know, you don't want to get them into where the return's almost done, that's going through quality review, and the reviewer says, oh, whoops, you've got a non-cash donation on here. We can't do this return. And then everybody's upset. The preparer prepared it all. It's all done. The client's mad because he's got to go around. So the sooner we tell people, the better. And so you can see this term, this sheet, and, you know, Gene has highlighted or underlined some of the real common ones that we see here that make it out of scope. I would have underlined one other, and I don't even see it on here, is married filing separate is one of the biggest ones that do. And some people just, pardon me?
That's at the top of the right-hand column.
Oh, I'm sorry. I'm blind. Okay, yeah, right. That's okay. Because that's one of the most common ones. And, you know, that people don't understand that. They, you know, what, I haven't lived with her for over a year, you know, or him or whatever. So, and, you know, I don't think I've told this class this, but, you know, you might ask, or you see even in the tax code too, a lot of where married filing separate doesn't work. I'm going to tell you right now, there is never an advantage to somebody doing married filing separate. There's one I could think of which would be so far outlandish, you'd never come across it. Okay. But there's no tax advantage. And then here in Arizona, let's see, Brian, I'm going to mute you. I hope you don't mind. Oh, there he goes. Okay, he got it. The real big reason we don't do it here in Arizona is we're what's called a community property state. And this is good information to know if you don't know it, or to even understand just personally. When you get married, half of everything you make is your spouse's, and half of everything they make is yours. Half of every bit of your withholding is theirs, half of their withholding is yours. So if you're living apart, and sometimes you're separated and sometimes you're not talking, how are you going to file an accurate tax return? Now, there's some exceptions under Arizona law. If you've really lived apart more than 6 months, you could file a single return, but we don't get into those things at VITA. If they're married filing separate, we just don't do it, period. Session 4. So, we've already done homework review, and what we're going to start now is start with standard and itemized deductions, and that'll probably take us to the break. And then when we come back, we're going to talk about credits. And I doubt that we'll finish through this. We'll probably have to pick up a little bit of it tomorrow morning for that. And then sessions 5 and 6 go pretty quick. We can kind of do that. So, excuse me 1 second. We already kind of earlier gave you that definition of what the standard deduction is versus itemized deductions. And since the Tax Cut and Jobs Act, the Trump Act, where they doubled the standard deduction, you know, 9 out of 10 people we see, or even higher than that, are not going to itemize deductions. However, there's going to be several people that they've been doing it all their life. They own a house, they got mortgage interest, and even some of them, they almost just insist that you put them in, and we just do it. Okay, we put them all in. It doesn't take that long if they're organized, and usually those folks are organized. And then we let the software tell them, and the software will actually print out, you know, a comparison of the itemized versus the standard deduction. And I think Gene tells a little story where he's actually had somebody go do that, and they just insisted they were going to itemize until he showed them the comparison and said, okay, so do you want me to take your itemized deductions? And oh no, I saved a lot of money taking the standard, you know. So that's really what it has. Here's the big deduction that you get is mortgage interest. That's usually, you know, if in property taxes too, if you own a house. And if they do own a house, there's something you really want to consider. You want to kind of add up or some things. What is their mortgage interest? What's their real estate taxes? There could be medical expenses, and I forgot to change this slide, Gene. This should say 7.5% of adjusted gross income. But in a minute, I'm going to explain what that limitation is. But if they've got huge mortgage interest, huge medical expenses, you know, a lot of real estate taxes, we might itemize on their return. Or remember the gambling thing? You know, if they're these gamblers and they end up with $20,000 of gambling losses and $20,000 of gambling income, we might have to itemize just to be able to take those losses. So if you're not sure, go ahead and enter all of it and let the software tell you, and we can print out a comparison for them. Again, this is saying the same thing. So here are the standard deduction amounts, and you might say, oh, those amounts look familiar. And the reason they might look familiar to you is if you go back to the first part we covered about who must file a tax return, you'll see that these are the amounts that are in that. You know, if their income, if you're single and your income's over $12,550, then yes, you have to file a tax return. Because remember our general tax formula, total income minus adjustments is adjusted gross income. And then you take off deductions and you get to taxable income. Well, if their total income is less than $12,550 and we take off $12,550 for the standard deduction, they have no taxable income. So that's it. But now there's some adjustments to this, and warning, heads up on some of your returns or on some of the tax questions on the test. There's some of these adjustments to the standard deduction, so you got to watch out for them. Okay, one is you're going to add $1,350 to the standard deduction for each person who's 65 or older. You're going to add $1,700 to it if they're over 65 and filing as single or head of household. And if they're blind, and actually, I don't think disabled counts anymore. I thought I changed this on this. It's just blind. They get an additional $1,350. Now, you're going to say, do I have to remember all this and change that? And the answer is no. However, when you start the tax return and you get on that first page, and Gene kind of showed this, it's where you put in the name and address and their date of birth and their occupation. And he kind of alluded to all those little boxes that you can check down there. Well, one of those boxes says, oh, is he blind? Right? And by the way, you're not going to see that on this test, but TaxSlayer will look at the age that you enter. And if they're over 65, then they're going to increase the standard deduction by that. So you don't necessarily have to memorize these, but again, here's where this comes in handy. If you're going to go back and review your own work, you finish the return and they're married filing jointly, and you get down and you look at the standard deduction and it happens to be $26,450, and you're going to say, or 26,450, and you look at that saying, no, it should be 25,550 or 25,100 rather. And then you go back and you think, oh yeah, one of them's over 65. That's why. So it's good to know this, is why I'm telling you that. So I've already talked about this, that they can either take the standard deduction or the itemized deductions, whichever results in the lesser amount of tax payable, which another way of saying that, if they've got more itemized deductions than the standard deduction, we take the itemized deductions. It's pretty much that simple, okay? I'm going to stop right there for 1 second too, because here's a little twist that we have in Arizona. Well, no, let me give you that little twist when we get down to medical deductions. Okay, good. So again, they should itemize that their total allowable deductions are higher than the standard deduction. And of course, we say when married filing married filing separate, rather, I'm sorry, it is out of scope. Let me give you one of the reasons. A moment ago, I told you there's never an advantage to doing that. And so, earlier on, some bright married people sat here and thought, oh, wait a minute. Let's just do married filing separate and you take all the itemized deductions and I'll claim the standard deduction. And we'll kind of get double. And IRS said, no. You can't do that. If one of you itemizes deduction on a married filing separate return, then both have to. There's another reason why we don't do married filing separate returns. So here we go on the Arizona state tax return. You can file the standard deduction on the federal and file itemized on the state return. And you might think, why would you want to do that? Because we're going to find out in a minute that there's a limitation on medical expenses on the federal itemized deductions and a limitation on taxes. But excuse me, the state allows for 100% of medical deductions. So it could be advantageous to file that. So how do you have to go figure that out? No, you do a little quick calculation, especially if they've got huge medical expenses, right? And you then just decide as a tax preparer, look, I'm just going to input all of their itemized deductions. And then TaxSlayer is going to figure it out. And TaxSlayer will know to file itemized on the state and standard on the federal if that's the most beneficial way to do it. So here's a screen where it says deductions, but right in here, you're probably never going to have to click on the standard deduction. I think the choice here is to force a standard deduction, which you're not going to want to do, let the taxpayer. But here, if you're going to itemize deductions, you're going to click on this begin right here to get into the screen. So here's just kind of a little quick recap. So if you're single and the standard deduction is $12,550, but if the itemized deductions add up to $15,759, which type would be best? Well, yeah, itemized deduction. So I think you get it, right? Here's another one. So you're married filing jointly, which is a $25,100 standard deduction, but you total up all of the itemized deductions and they come up to $14,500. Well, we're going to take the standard deduction. Head of household, kind of same thing. 19.5 is more than 18,800 too. So what are itemized deductions? They're all eligible expenses that you can claim on your federal income tax return that decrease the taxable income. And these are claimed in place of the standard deduction. So let's take a look at what some of those are. So here's the first one, medical and dental expenses. And I will tell you, not many people get to, even in the days when we were itemizing a lot, okay? Not many people get to deduct medical and dental expenses because, first of all, if they're covered by insurance, you can't claim them, right? It's not income. And they have to exceed more than 7.5% of your AGI, your adjusted gross income. See, there's another benefit of getting adjustments rather than deductions because it lowers your AGI. So if you have a 50,000 AGI, what's 7.5% of that? $3,750. Now, think of yourselves, and it's possible you may have had that. I had a couple of surgeries when I was at Maricopa Colleges, and our insurance policy had a $5,000 maximum out of pocket. That's paying all the deductibles and the co-pays. Once you hit $5,000, there's no more payment. But I made more than $50,000. So I'm going to tell you right now, I got no medical expense deduction, even though I maxed out my insurance and everything else, right? Usually this occurs for people who don't have insurance, or they have some qualified procedure that is not covered by insurance. That's usually where you see that they've got these medical and dental expenses, or sometimes huge dental expenses will catch over, but it's not really likely. The second big expense you have are taxes. And these include property taxes, like on real estate, usually your house, that's the big one. And one of the biggest qualifiers we do is, do you own a house? If they don't own a house, man, it's rare they're going to itemize deductions, almost never. Okay, because mortgage interest and real estate taxes are the biggest one. State income taxes is deductible, and that's the amount that comes on your W-2, your Arizona tax withholding. But the Tax Cuts and Jobs Act, the Trump Act that got passed, they capped that at $10,000. So even for those wealthier taxpayers who would be itemizing, I have one client like that. I mean, it gets cut off at $10,000. She owns a house in California too, and taxes are way up on those too. You can add into taxes, if you bought a car and the sales taxes on the car, you could do that. So taxes are a big thing. Mortgage interest is usually one of the biggest itemized deduction that they would take. And oh, by the way, it's not on here, but the under legislative extenders, the Congress, there's been this thing, those of you who own a house, there's something called PMI, or mortgage insurance. If you only put down less, if you didn't put down more than 20% of a down payment, you got an FHA loan or something like that, they tack on this mortgage insurance premium that you have to pay in case you default. And it kind of went in and out of whether it's deductible, and one of those legislations may, put that, I think it's only till 2025, but you can deduct mortgage insurance premiums.
Hey, Jim?
Yes.
The question came up under deducting medical and dental expenses. We had to have, you could only deduct more than 7.5% of your AGI on the federal return. When we deal with the state of Arizona, can we deduct more than the 7? Do we have to deduct more than 7.5%, or can we deduct all of it?
You can deduct all of it. And, just to be clear, let's take simple math. Your AGI is $100,000. Let's just say that. Okay. And you come in to have it done, and you've got $8,000 of medical expenses. Well, 7.5% of 100,000 AGI is 7,500. Your medical expense deduction is 8,000 minus 7,500. You only get to deduct 500 on the federal return. But on the state return, you get to deduct the whole 8,000. So that's why sometimes we're going to want to itemize deductions on the state return, even though we take the standard deduction on the federal return. It's a good question. Very good. And hopefully that clears it up. Moving on. So the reason I'm emphasizing the mortgage insurance premiums is, hint, hint, you're going to find one of those on your test. Okay. So next we have charitable contributions. And there used to be a limitation on adjusted gross income. I will tell you, you hardly will ever see that. I've seen it in some very wealthy taxpayers, but most people, even wealthy people, don't give away. It used to be 50% of your adjusted gross income. Even them, they don't give away half of their income, right? I mean, some do that are just, they're uber wealthy, right? And so that there's a limitation. The CARES Act raised that up to 100% of AGI that you could do of charitable contributions. But charitable contributions are an allowable deduction. There's a lot of rules that go with that, substantiation rules. If the charitable contribution, the cash contribution, cash or check, is $250 or more, then the taxpayer has to have a letter from the organization saying that, hey, we received $250. Thank you very much. You didn't receive anything in return. Or maybe they went to a banquet dinner, donated, $400, and they say, oh, thank you for your $400 contribution. The value of the dinner was $50. And then they only get to deduct $350 of it. So the reason I'm only telling you this is, if we start doing those things, we don't have to see those letters, but I like to make sure that the taxpayer knows that. All charitable contributions have to be documented, and the documentation, if it's less than $250, can be just a note on the calendar, right? Or something, but you need to have a record if they get audited. Now, remember, I'm going to just remind you right now, even if you don't itemize deductions, you take the standard deduction, you can still deduct up to $300 per person as an additional, in addition to the standard deduction. The substantiation rules apply to those as well. So if they tell you, yeah, I got $300 of contributions, and if I hear them just say that off the top of their head, I'm going to remind them of these rules that, hey, you've got to have some records. If you get audited, you're going to have to show it. And remember, you're responsible for everything that's on this return. It doesn't mean I won't do the return unless I really think they're, unless they're really glib about it, But okay, so this is a screen where you would go enter in. Once you click on itemized deductions on that previous screen, here's where you're going to get to enter medical and dental expenses, taxes that you paid, mortgage interest and expenses, gifts to charity. Now, I should back up 1 second. Charitable contributions, I left something big out, okay? Charitable contributions can take the form of cash or check, but they can also be non-cash. You donate things to Goodwill or St. Vincent de Paul or Mary's Food Bank or whatever. So, but there's still documentation rules. You need to keep a record of what those are. Now, here's a big one that's out of scope. If the non-cash contributions are over $500, you have to file a whole separate tax form, and you've got to give a whole lot more detail. And oh, by the way, that is out of scope for us. Now, I know this question is going to come up, so I'm just going to address it. Sometimes taxpayers will say, well, if this is the only thing that's out of scope and I gave $750, just put down $499. And there's no reason we can't do that. And in fact, if we have to send them away to a paid tax preparer who's probably going to charge them $300, $400 for doing an itemized deduction return with non-cash charitable contributions, the value that they're getting doesn't even come close to that tax fee. So that's okay. There's nothing wrong with that. They don't have to claim all of their deductions. So I just wanted to kind of let you know that. Somebody clicked in here. Did they have a question, or was that just kind of a...
Jim?
Yes.
Jim, Mary Ellen here. I have a question.
Yes.
Yeah. Yes, that was me, Mary Ellen. Can you go back and just reiterate the deductibility of mortgage insurance premiums? Is it, or is it not deductible?
It is deductible. It's one of those things, Mary Ellen, that seem to come in and out of the tax law. And with the last legislation that they put in, they made them deductible again. I think it expires in a couple of years again. That it seems to be one thing that Congress bats in and out. The direct answer to your question, for 2021, mortgage insurance premiums are an itemized deduction. Okay?
Thank you.
So now here's another thing with those medical expenses. They have to be paid in the year of 2021, and it can be for the taxpayer's spouse, or the dependents, listed on the return. Now, often, especially if you get those unfortunate cases where something's not covered by insurance or whatever. Usually cash basis taxpayers, and we are all cash basis taxpayers, we only get to deduct things that we actually paid for. One exception to that is if you charge it on a credit card and you haven't paid off the credit card yet, but IRS does accept the fact that if you charged it on the credit card, you get to deduct it that year. So just a little side note for y'all too. So here's, medical expenses. So, and this is kind of an example of York and Cindy Young had these medical expenses. So, and it's showing you where you could put it. So they have medical insurance, like a supplemental policy. If once you get on Medicare, you buy this extra policy, or maybe you bought one of those, what's the duck insurance? I guess you guys don't remember the commercial. Aflac, yeah, right. That was a supplemental policy. So you could put in these extra insurance premiums there too. And then, we've got this amount here that you can put in for doctor bills, right? Prescription drugs, hospital bills, all of these things, we put them in these sections right here because it prints out a record in their tax return of what we did. I will point out one other thing here that's here, long-term care policies. There's some special rules for that. And that's why you click on this little box to edit premiums, because it depends on your age. There's a sliding scale. Of course, the older you get, the more you're able to deduct. I will tell you from personal experience, long-term care policies are extremely expensive, and the amount that they allow you to deduct doesn't usually equal the cost. It's somewhat lower. However, the tax software knows what it is. They'll cut it off and limit it for you.
Hey, Jim, I forgot one more thing about that screen.
Yes.
It shows there's little boxes on the right-hand side of the screen with 3 little lines in them.
Oh, yeah.
That I don't think we've explained to them what those do. Those
right.
were there when we first started using TaxSlayer. And so we had to, like, for the amount paid to doctors and dentists, we would have to add those up individually and then plug in the number. So I'd have to do the calculations. That's kind of scary. If you click in that box, it brings up an empty descriptor box and then an amount. So you could put in doctor bill for York and Cindy, $26.53. Then you click add, and then you get another box and you would type in the next item, dentist bills for, and you would put in that amount. And the software will then calculate it, plug the total about into that box where you see the $29.93. And when it prints out the return, it will list all of the items in each of the boxes. So I forgot to even cover that in terms of the TaxSlayer screenshot, but those little boxes are pretty handy for doing multiple items.
Right. And then if they get audited, they've got, they don't have to remember exactly what they've got, and they'll be able to go find their receipts or whatever for that too. So it's really a good idea. So now here's another example of taxes that are deductible, are personal property taxes, they call it. But they have to be personal property taxes that is a tax on the value of the item. We all know of our vehicle registrations, and this is really good. And some people come in here and they'll say, oh, hey, I paid $109.84 for my vehicle registration. And we got to say, no, we need to see the registration, because only the vehicle license tax is deductible. Now, okay, I'm not going to belabor this because, as I said at the beginning, in fact, I've already belabored too much about itemized deductions. We're not going to see many of them. So I'll just skip this here. Here's a property tax bill. And we are going to go over this tomorrow when we talk about the Arizona property tax credit. But the one thing I'm going to tell you, first of all, about this is you need to be very careful about how we pay. If they come in here with a property tax bill, you've got to know what they actually paid. Because when they get the bill, it's going to tell you the way you pay the property taxes is you pay the first half in October of that year, and the second half you pay in March of the next year. So really in this year, 2021, if they paid it in 2 payments, they paid a March payment, but that was for last year. And then they paid an October payment that was for this year. So you can't really tell from this what they actually paid. We'll show you how you can get to the actual receipt if you need to. However, here's the real simple. Most people pay their property taxes out of an escrow account with their mortgage, and then they get the 1098 from the mortgage company, and it tells you right on there what the real estate taxes that were paid out of escrow. So normally you don't have to go through this trouble unless we do a property tax credit. And then we have to. And this is the site, and we'll show you here where you could go in and you get the parcel number. This is the site on the Maricopa County Treasurer's Office. And in case you guys didn't know it, if you're homeowners, and I love to tell this story though, if you're homeowners, you know, anybody can go find out what you're paying in taxes. And I used to teach a sales, property, and payroll tax at Scottsdale Community College. And I used to like to pull up the screen and show the students, right? And I pulled up my bill, and there was one of these days where I had my taxes paid out of an escrow account, but I had paid my mortgage down, and I thought, well, hey, I should just be keeping this money in my bank account instead of letting them. And I closed the escrow account, but you know, they don't send you a lot of reminder notices about your property taxes. And I just forgot all about it, right? Until I'm teaching this class and I pull up this and I pull up my property to show them, and it shows delinquent. So I had to gulp, and I had to run down to the treasurer's office and pay it. So before they started selling a tax lien on it, but I don't know, it's kind of funny. So here's the screen where you're going to put in taxes paid. And, you know, the most important would be, this is additional state and local income tax that, and it says, don't include the amounts from W-2s or 1099s that we put in there, because taxpayers grabbing that. But sometimes you'll find people who made additional payments, or you made an additional payment with your last year's tax return or things like that. Here you could have real estate taxes, but it warns you, taxes here will overwrite any other real estate taxes already made. And when we put in the mortgage interest, it asks you for real estate taxes there. Here's where we put in the car registration tax, the vehicle license tax that I told you about. So there's also a sales tax deduction, and I'm really going to go fast over this because even when you itemize deductions, you know, 9 of the 10 people we have won't itemize, and of the 1 out of the 10 do, 9 out of 10 of those just take what the program calculates, unless they've bought a large vehicle, right? But our tax rates are based on our sales tax rates. Many of you know this. You know, you go shopping in Phoenix, pay one sales tax rate, and you go over to Mesa, and it's a different sales tax rate. And that's because the sales tax rates are combined by county, state, county, and city. There's 3 different versions. There are 3 different components of it. So it depends on what city you're in. And we get a little chart like here. And if you ever have to drill down and put in these rates, and sometimes it's advantageous, but it's so rare, I'm really not going to have you go over this. You know, if you get into one of those, sometimes the quality reviewer might come up with it, and that would be the good place to show you right then. Okay, so other parts of itemized, we talk about mortgage interest. Mortgage interest is a big one, and that's on your first or second home only. I had a home here. I used to have a cabin up in Pine, and I would deduct the mortgage interest on both of those. But your second home could also be a motor home, trailer, boat, as long as they have sleeping quarters. You could do that. When you first purchase a house, sometimes you pay points, which is actually prepaid interest, but the Form 1098 is going to tell you the points that were paid. And then, of course, we already talked about property tax paid. Now, home equity line or credit. It used to be, before the Tax Cut and Jobs Act, people would go out, okay, I'll give you a longer history. About 20 years ago, oh no, it was the Reagan Tax Act, so it's probably longer than that. You used to be able to deduct interest on your credit cards and auto loans and things like that. And so they cut that off, said no, only homes. So then what happened is it built this whole industry of second mortgages or home equity lines of credit. And people would take out a home equity line of credit and then buy their car or do all that or pay off their credit cards with it. That way they could deduct the mortgage interest. Now, the Trump Act, the Tax Cut and Jobs Act came along and said, okay, that can only be if you're using the funds for the purpose of buying, building, or substantially improving the residence that's secured by the indebtedness. So it has to be a loan that's used to improve that residence. For instance, I couldn't have taken out a loan on my house here, use the money to fix up my cabin in Pine. I would have had to use the money to fix this up here, or otherwise it's not deductible. So that's awkward. But if you find somebody brings in a document about interest on a second mortgage, you need to ask them what the funds were used for. Okay. Again, now we're getting into the rarities of itemized deductions. So here's a 1098. This is what they report mortgage interest. And here's where you're going to get almost all the information you need. Here's the mortgage interest that was received, the mortgage origination date. You don't really need that. Here's where it's going to report mortgage insurance premium. So it's going to tell you right there. Here's where it would report points they had to. And look down here. Here's your property tax. Most of these forms, because usually there's an escrow account with it, and the bank or the mortgage company pays your property taxes and your insurance, your home insurance. But hey, guess what? Home insurance is not a deduction. So you don't get that. Okay. So here's the form that we report that on. Right down here is where you would put in the PMI. Okay. So here's a few things about gifts to charity. So, can you get the habit of, you got a stack of dollar bills in your car and, the guy's out on the corner, you kind of help him out. Can you deduct that? No. Has to be to an organization. And actually that organization has to be on an IRS list. And you could find that list if you really were curious. Most of the times, no. They have to be what's called a 501c3 organization and to be on that. Then also, okay, this would apply to you guys here. When you're traveling to your VITA site, you're traveling as a volunteer, you could deduct 14 cents per mile. That's if you're itemizing, which I doubt you will, but still you shouldn't forget mileage for doing that too. And I skipped it. I didn't see it in the slides, but there's also medical miles that you can add in for a deduction as well. So can you take a deduction for the cost of a raffle ticket sold by the church? No, that's not a charitable contribution. That's because you're spending the money in the hopes of winning something, not out of the goodness of your heart. Even though it's like a 50-50 raffle and they get to keep 50% of it. No, it's not deductible. Here's the gifts to charity screen, and they'll ask you to put in individual ones. I would tell you sometimes when they come with a list of $100 to KJAS, $100 to PBS, and $200 to St. Mary's Food Bank, and all of that. Sometimes, if they're just small individual ones, I'll add them up and I'll put in one entry that says various charitable organizations. And I tell the client, keep these documents with your tax records, because if you get audited, they're going to want to see those, right? Or you could just enter them individually. Yes, Gene.
I was going to remind that screen is an old screen because they've TaxSlayer put in an override box. And so if you've got a lot of little charities like what was shown on the screen there, the Ties to the Church, American Cancer, Millsap Elementary, you could put on an override and click the override button and just put a total in.
Yeah, right. So as we said, this is a screen for non-cash donations, right here. And less than or equal to $500. And if it's more than 500, it's out of scope. Okay, gifts to charity, I've already talked about this stuff, that they have to have documentation, which could consist of a check or a canceled check. But even if they've got the canceled check, if it's more than $250, they need a letter from the charity. Okay. But if it's less than $250, they can substantiate it using these ways: a bank statement, credit or canceled check. This is the written communication that comes, and that would give you the name of the charity, date of contribution, the amount of contribution, and doesn't say it on the slide, any value received for that contribution as well. So non-deductible items, cost of raffle, bingo, or lottery tickets, tuition. I mean, even, you're thinking, yeah, I'm gifting my niece, this tuition and stuff. I mean, that's for her charity. No, she's not a 501c3. Okay. The value of a person's time or service. Sorry, guys, you can't deduct the value of your time in preparing tax returns. I mean, you could, if you were claiming the income from that value, and then you would just offset it, right? Do you see what the difference is there? You can't deduct the value of your blood. Car depreciation, although for performing services, although there is that mileage deduction. Okay. We've already kind of talked about most of these: sickness or burial expenses. The part of a contribution that personally benefits the taxpayer. If you're receiving some benefit, that portion you can't deduct. I just gave the example of the banquet meal or something, but so that was itemized deductions. Gene, let's pause for a second and see if we had any questions.
I think we're all caught up on the chat. Oh, wait a minute. Here's one that just came in. If you pay tuition directly to school, it is a tax-free gift. Well, in Arizona, it's a tax credit that could lower your tax bill.
I'm going to modify that a little bit. Okay. You got to have more information than just what Jennifer's saying. Okay. Because usually tuition directly to the school, it's usually not a tax deductible deduction, but many schools, they create a foundation, and then the deduction, the payment to that foundation could be similarly. And I haven't confused these yet, but we're going to get into Arizona tax credits. And there are such things as called Arizona school tuition organizations. And those you can give money to those tuition organizations. And for Arizona, you get a dollar for dollar credit, but just hold on to that till we get back to it. Usually, okay, so I worked at Scottsdale Community College. If I wrote a check to Scottsdale Community College, it is not deductible. However, they also have a foundation that I could write the check to, and that is deductible. I also run a faculty foundation, which, by the way, I got qualified as an Arizona qualified charitable organization. And we have faculty members that give us money for emergency scholarships for students, and they get to take the Arizona tax credit. But again, park that on hold. So,
sorry, earlier you were just saying something about if you pay like your niece's tuition, it isn't charitable. It isn't. I was just making a one-off comment that.
oh,
But it is a tax-free gift regardless of the amount.
yeah. And so what Jennifer's saying is, if I gave my niece, $1,000 for her tuition, she doesn't have to pay tax on that because it's a gift, right? That's one of those things that are excludable from income. But I don't get a deduction for it. On the other hand, if I pay that $1,000 to a tuition organization, and careful here, what I'm going to say is really not correct. But if by some chance that school tuition organization decides to grant her a $1,000 scholarship, well, then I can deduct the amount to the tuition organization. Now, usually there's rules with that. I can't specify where that money's going to, or otherwise it disqualifies the gift. But I think sometimes they find ways of working around that. But so anyway, good. So we are at 2 o'clock, so we're going to go for about another half hour. I'm going to start on credits. And then when we take a break, then Jean's going to come back and finish up. I'm not sure we'll get through credits, but maybe through the most of it. Credits are one of the biggest ways we help our clients. And some of these clients, they can get huge amounts of money. I mean, it's especially huge for them. Okay. Often this is the biggest source of money these folks are going to get in the whole year. And I will tell you, sometimes at our sites, they're lined up around the corner the day we open because they know they're going to get that filed and get money in the bank. So this is a really important part of what we do. So there's a big thing. And actually, before I even get to this screen, I really just want to talk for a second because it really helps to get a big picture overview of this. There are refundable credits and non-refundable credits. And then you're going to see this repeated, but I think it's better to give you the big overview right here. A non-refundable credit means you come down, remember our formula, income minus adjustments is adjusted gross income minus deductions is taxable income. I'm going to add one more thing to that formula. Then you get the actual tax on that taxable income. A non-refundable credit can lower the tax that you have there down to zero. But if the credit is larger than zero, you don't get a refund. You don't get extra refund. On the other hand, there's a refundable credit. And those, you can, if there's a tax there due, a tax amount, it lowers it to zero. And if there's any left over, it adds to your refund. As such, that's why they call it a refundable credit. So first of all, and what is a credit? It basically gives you a dollar for dollar value. It actually lowers the tax. A moment ago, we just talked about deductions, and a deduction lowers your taxable income. So if you have a $100 deduction and you're in a 20% tax rate, what's the value of that $100 deduction? Well, you lowered your taxable income by $100, so you lower your taxes by $20. 20% of the tax is your tax rate. So to sum up, credits are better than deductions. You get a dollar for dollar instead of just the tax rate off of it. And refundable credits are better than non-refundable credits. So kind of keep that big picture over. So we kind of start here, and we said, as we said, a refundable credit are subtracted from the amount of taxes you owe after deductions. And these are particularly advantaged because it can reduce your tax liability to below zero. In other words, it makes it negative or it increases your refund. So non-refundable credits, though, it's a dollar for dollar reduction in your tax liability. They're valuable as long as you've got a tax liability. And I also want to back up for a second. Sometimes when you're trying to explain this to people, when they think of a tax liability, they're thinking, oh, I finished my tax return. I got to send in $200 to the IRS. No, that's not what we're talking about. That's the tax due, right? We're talking about the total taxes you owed before any payments like withholding or other credits, right? So it starts up there. So it's got a dollar for dollar value for that. But a non-refundable credit only reduces that tax liability to zero. And if you've got an excess, it doesn't add into the refund amount. So and big heads up here, folks, because sometimes in your tax returns, you're going to have to enter in some credits, and there isn't a separate credits menu. It's buried under the deductions menu. So you got to first, you get the federal income tax over there on the left side, and then you do federal income tax, and below income, there's deductions. You got to click on deductions, and then there's a credits menu right here that you're going to get to. And it tells you here, child and dependent care credit, education credits, mortgage interest credit, etc. So you click on edit there. And then here you get a variety of credits, several which are out of scope, okay? So here's the recovery rebate credit. Now, last year, when we entered a tax return, TaxSlayer prompted us right away. I'm going to back up for just a second here because a lot of you didn't prepare taxes last year. But just to remind you, and first of all, the recovery rebate credit, IRS likes to make up their own names for everything. Well, Congress called it the economic impact payments, right? We call it stimulus payments, right? The man on the street, right? That's the recovery rebate credit. Now, last year, we got two of them, and this is kind of confusing because we got a big one, like $1,200 per person in March of 2020. And then we got a second one, like the end of January, 1st of February, we got like $600 per person and dependent. But that one in January or February, I forgot when it came, those we had to account for on the 2020 tax return. Now we got a third one in March, a big one, $1,400 a piece. That one we're going to have to account for on 2021. And last year, TaxSlayer, they prompted you right away to enter in the recovery rebate credits. But if you made a mistake or had to get back to it, you'd come in here. So what you want to put in there is, and when you're talking with the taxpayer, you need to ask them, what did you get, for recovery rebate payments? And they're going to say, well, they're supposed to have a letter, okay, form 1441 or something like that the IRS sends. Half of them won't bring it or more, but then you got to ask them to kind of look through their bank account, and sometimes they didn't get all of it, or maybe they had a baby, in 2021. They're going to get $1,400 more, So here's where we go in. All we have to put in is what they actually received. Okay. There's a foreign tax credit. And I know this says out of scope, and you've heard us say earlier, we brought your attention to those forms like the 1099 DIV that said foreign tax credit. We're allowed to do the ones that are reported on the form, the 1099 INT or DIV. What we can't do, and here I'm going to bring you back to the big concept again. You don't usually have to pay tax twice on the same dollar. So if you own an investment in Denmark, in a Danish company, you own Danish stock, and they give you $1,000 dividend in Denmark, taxes that at $200, right? That's a foreign tax. We have to pay tax on the $1,000 dividend at the US rates, but then US gives us a credit for the amount we paid to Denmark. Okay. We can't do those. We can only do the ones that are kind of automatic, right? Just so you know. Then we're going to go over in depth these things right here. There is an adoption credit, but it's out of scope. And then in a little bit, we're going to also go over these credits for sick leave and family leave. That might be the part that might happen tomorrow. There's also this first-time home buyer credit. You're not likely to see any of those. I've only seen like twice do it, and they're almost gone. That came about in the 2008 housing crisis. I'll talk about those in a second. So here we go. We're on the deductions menu. We go to the credits menu. We've already talked about these things, so I'm going to kind of go on a little bit here. Okay. This is, if you scroll on down the credits menu, this is below what I just showed you, right? There's some more, more credits. There's a credit for elderly and disabled. It's rare. Their income has to be very low, but it is a refundable credit. Then there's a lot of these that are out of scope. Motor vehicle credits. I mean, if you, I have a Prius Prime, which is kind of a plug-in hybrid. And when I bought it 3 years ago, I got to claim a pretty substantial credit. We can't do those. Okay, they're out of scope. So I won't go over the ones that are out of scope. Let's go to the big ones. And by the way, there's going to be some big changes this year in this. The Tax Act that Biden got passed, I forget the name of it now.
American
Okay.
Rescue Plan.
Yeah, the American Rescue Plan, ARP, right? It really boosted a lot of benefits, made a lot of changes to these credits. So they're going to see. So the first one we're going to talk about is child and dependent care credit. It used to be a non-refundable credit. Now they've changed it to a refundable credit. So we've already talked about what those are. And note the title here, child and dependent care credit. Maybe your dad lives with you and he requires daycare, and so that you can go to work. So it's not just child being in daycare. It could be home health care for a dependent that allows you to go to work. So credit can be claimed by taxpayers who, and this is an important thing, in order to work or look for work. We're going to see many that got unemployed. And if they had to pay for daycare for the kids so that they can go out and look for work, that qualifies them to. So now this is going to be for their dependent child under the age of 13, a spouse who can't care for him or herself, or dependents who can't care for themselves. So, and there's two parts to this child care credit. This is a tax slayer screen. You have to put in both the amount you have to put in the provider who provided the care, and you have to have an employer identification number, or if it's a person, a social security number for that person that paid the payments to. And then you have to put in which dependent was paid for. And if, like they're watching too, you paid $800 for, 800 would be small. That's more like, 3,000. Right? If it was equally for two kids, you'd put 1,500 under one dependent, 1,500 under the other. Okay. So you have to put them both under the providers and the dependents. So here's a screen where you've entered in two dependents and you put in, qualifying expenses was $1,100 for one, and it looks like $0 for this one. I'm not sure why, but maybe this is because TaxSlayer just carried this over, and now we've already put in $1,100 for this one. We're going to click on that little pencil icon, which means edit, and then we're going to put in the expenses for this one, second dependent. Gene, were you going to say something? No, I was just hearing things, I guess. Okay. Now, this credit got expanded immensely with that February Tax Act, too. In general, it ranges from 35% to 50% of the qualifying expenses that you paid. It depends on your income. As your income goes up, the amount that you qualify goes down, okay? As it says right there, and it used to max out at a pretty, I forget the actual number, but they increased the number, but we're going to show you here what this looks like here in a second. So if they receive, sometimes maybe you guys have worked for an employer where the employer, part of your fringe benefits was they paid for daycare for your kids. And if they did, it's going to show up on a W-2. Where's my cursor here? W-2 in box 10. And when we input that in TaxSlayer, it's going to automatically generate this form 2441 to determine if we could exclude all or part of these benefits from their taxable income. Again, TaxSlayer will do that part of it too. Married taxpayers usually must both work or be looking for work to claim the credit. The one exception would be that is if one of the spouses, they're treated as working during any month that they're a full-time student, or they're not capable of caring for themselves too. But if only one of the spouses work, the other one stays home, IRS is saying, hey, why can't you take care of the kids, right? So that's the reasoning behind that. Now, here's the big thing. I'm trying to remember the limits in 2019 and before was way lower.
The limit was 4,000.
Yeah.
So it's doubled.
Yeah, so it's double. It's 4,000 for one qualifying person, or 16,000 for two or more qualifying persons. Now, that's the limit on the expenses paid. you know, you don't get that full tax credit. Usually, we're going to get to a screen here in a second that says you get a percentage of that too. So in 2020, the full credit that was available, the most that they could have gotten was, it was available for families making up to 15,000. Is that right, Gene?
Yeah, that was their adjusted gross limit. That's where the credit phased out at.
Yeah, okay, right. And look what they did in 2021. It goes up to families making up to 125,000. They boosted it way up. Only the custodial parent can claim the child and dependent care credit, even if the exemption is being claimed by the non-custodial parent under the rules for divorce and separated payments. So let me refresh your memory back that. Remember where we said that the custodial parent is the one who's entitled to the dependency, but maybe they sign away the dependent credit to the other spouse. So the divorce decree said, hey, you get it 1 year, they get it the next, right? So they sign that form 8331 to give it. Well, even if they give away the dependency exemption, only the custodial parent can take this credit. So, and even if you've given away the exemption, you get, or given away the deduction was a better way to say it. We used to call it exemptions, but even if you've given away that deduction, you still get to claim the credit. But even for the parent who is the non-custodial parent, if he pays for these child care expenses, and he was given the dependency exemption by the custodial parent, he doesn't get to claim it. Only the custodial parent does. So here's an example: child and dependent care. Emily's 25-year-old son, Ray, lives with her. Oh, this is interesting. 25-year-old son. Okay. He was in an accident in May 2021, moved in with Emily. Since the accident, Ray has been physically unable to care for himself. He earned $8,200 and he paid all of his expenses until the accident. But since the accident, Emily's provided all of Ray's support. So you should be thinking to yourself, all of these dependency rules, right? Did he live with her more than 6 months? Did she pay for more than half of the expense, half of his expenses? And all of those things should be coming into your mind right now. Okay. Emily works 5 days a week and has earned income of $38,000. She cannot leave Ray home alone, so she has hired somebody to stay with Ray during the day while she is at work. And this is continued. Okay. So Emily pays Frances $150 a week from her pay. She's not able to claim Frances as a dependent. On her return, Emily has, did I skip something? Hold on. Yeah. I didn't skip anything. This is the provider she's paying for. Frances paying $150. She can't claim Frances as a dependent on her return. Emily has Frances's name, address, and social security number. Emily does not receive dependent care benefits from her employer. Emily has never been married. Emily can claim the child and dependent care credit. So think to yourself, I'm not asking you to chime in here, but this is a kind of an interesting case. True, even though Ray's income is over the income limit to be claimed as a dependent on Emily's return, he meets the qualifying person test for this credit. Now, I want you to think back to what I warned you about relationships and qualifying things. There's different rules for different credits and that. You need to look at the rules for that. And your 4012 has this rule in it. Go to G9 and you could look it up. G9 of the publication 4012. So here's another example. So Selena and Dave have been divorced since 2013. They have 3 boys, ages 11, 9, and 7. All the boys are US citizens, have social security numbers, and live with Selena. Okay. Dave and Selena both work, and the boys need childcare before and after school. Boys attend the Happy Days daycare center. Selena uses her alimony to pay the childcare expenses. Continue. Dave also pays Selena $1,000 a month for child support. Dave and Selena have the name, address, and taxpayer identification number for the daycare center. Selena's AGI is $37,000 and Dave's AGI is $42,000. Selena will claim 2 of the boys as dependents and Dave will claim 1. This was agreed to during the divorce and Selena signed Form 8332. Who can take the child independent care credit? Both of them, Selena or Dave? And the answer is Selena, because Dave can't claim the credit because he's the non-custodial parent, even though he gets to claim a deduction for one of the children. And even though he could argue, well, hey, that's what I'm giving you, the $1,000 child support so you can pay for the daycare, right? You hear these kinds of things. I'm not being facetious or sarcastic. I mean, you hear it, but these are the rules. The custodial parent is the only one who gets to take it. I think you get the point. I'll let you read this example on your own, okay? So we're going to move. What time have we got here? 2:20. Good time. And we're going to get through the child tax credit and then we'll take a break. Okay. So this was greatly expanded this year. I think it used to be $2,000 and the child tax credit, which was pretty good deal. I mean, $2,000 as a credit. And it used to be this was one of those weird credits to where it was basically a non-refundable credit unless your income was low enough. And then they had something called the additional child tax credit, which could be partially refundable up to $1,400. Forget all that I just told you because it's all gone now. I was just giving you some historical context. The new law says the child tax credit is fully refundable. And then they bumped it up from $2,000, bumped it up to $3,600 for a child under 6 and $3,000 for a child under 18. And that was another thing. It used to be only children under 17. So they really expanded this. And not only did they expand it, and here's what's going to come into some work for us. I may be getting ahead of myself, but I'm going to go ahead and say it here. They started making advance payments of this credit to taxpayers. And they were basing this on their previous year return. So just to keep the math simple, let's say you've got one child who's 15 years old on your last year's tax return. So you're now entitled for 2021 to a $3,000 credit. Now, they didn't start these advance payments till halfway through the year. So they were going to pay out this second half of this, the $1,500, on monthly payments to help. So now what we're going to have to do is they're going to come into VITA and they're supposed to bring a form that IRS is going to give them that shows them how much advance payment they got. And then they're going to get the rest of it on this return. But maybe they didn't get all the advance payments. I think you've all heard the stories of these debit cards that got lost, or they didn't have a bank account, all kinds of things. So we're going to have to ask them questions. How much did you actually get? So that then we get to reconcile it on the tax return, and then they get the balance on their refund. I saw a bunch of questions, but it looks like Jean's handling, so I'll just keep moving on here. Child must have a social security number issued before the due date of your 2021 tax return, including extensions, to be claimed as a qualifying child for the child tax credit. This usually doesn't impact us much because about 15, 20 years ago, when the baby gets born in the hospital, they get a social security number for them. I mean, it was pretty, but sometimes there could be, non-resident aliens that claim themselves as resident aliens. These get more complicated, and I shouldn't complicate it, but there could be some instance to where the child doesn't have a social security number or an ITIN. And actually, this one, they have to have a social security number. So what would be the example? Maybe they moved here and they've become residents, but haven't gotten a social security card. So they would have to get the social security card before they could, this could be claimed on the return. So I think I've pretty much covered this. And here's something I'm gonna tell you: always watch out in the tax law, because they say it both ways. Sometimes they have to say, they had to be 17 or younger, or sometimes they'll say under 18. Pay attention to the language. Those both mean the same thing, but they both use different numbers, right? 17 and 18. So pay attention to what this says here. So there's the first rule. They have to be under 18. They have to be a citizen. They can be a United States citizen, United States national, or resident alien, but they must have a social security number. Okay? And then the child must be claimed as a dependent on your tax return, and there's more. And here's a relationship test too. They have to be related to you as a son, daughter, stepson, stepdaughter, brother, sister, stepbrother, stepsister, grandchild, niece, or nephew. Always look up these relationships, like notice their niece or nephew. You probably haven't seen that in some of the other relationship tests. It could also include legally adopted children. Okay. And foster children, that are lawfully placed in your care. Residency, the child must have lived with you for more than half of the year. Temporary absences for special circumstances, like I guess being away to school probably aren't going to count unless they're going to like boarding school or something like that, because they've got to be 17 or less. And then there's always some special rules that apply to divorced parents, and they're in your 4012, so I would always caution you, if you're doing a return for a divorced parent, read the fine print sometimes, because there's sometimes special rules that apply for that. The child must not have provided more than half of his own financial support for the year. Generally speaking, if you provided the house, you paid the rent, the utilities, and bought the groceries, you've provided more than half of the support. But it's possible, well, okay. This is, you're going to find on the intake and interview form, there's a question on there that says, have you ever been notified that you're not eligible to receive any one of the following credits? And it'll say education credits, child tax credit, like that. And more people ask me, what is this? What does that mean? And basically the way I respond to it is, have you gotten a nasty letter from the IRS? Because what happens is there's been a lot of abuse with these credits. And when they catch you abusing it, they can ban you for like either, well, what it says there, 2 or 10 years. And when they do that, they send you a nasty letter, man. It's like, are they going to come and take me away here or something, And so these people know it, right? So I just asked them, I said, did you get a nasty letter from the IRS about anything? Oh, no, nothing like that. So it's okay. But they are really cracking down on these credits, IRS is, because there's been a lot of abuse with it. So here's an example of child tax credit. Mary and Ralph got a divorce in 2007. They have one child, Amy, who lives with Mary, big thing. They're all US citizens, have social security numbers. Mary and Ralph provide more than half of Amy's support. Uh-oh. So there's 2 people providing more than half of their support. And then we show Mary's AGI is 31,000, Ralph's AGI is 39,000. You're going to find sometimes in these tiebreaker rules where AGI plays a big account. But let's continue here. Divorce decree does not state who can claim the child. Ralph is the non-custodial parent and can claim the child tax credit only if Mary signs Form 8332. Mary can still claim the earned income credit, head of household, child independent care credit for Amy, assuming she qualifies for them. So when she released the dependency, Ralph is going to get the child tax credit, even though he's not the custodial parent, but only that credit. Only don't confuse the dependent and care credit with the child tax credit. They're different credits. Stan files as head of household, has 3 kids, 9, 11, and 13, all who qualify for the child tax credit. Stan makes $54,000. His tax liability is $4,000. Stan is eligible to take a child tax credit up to $9,000 to offset his tax liability. How much will Stan's refund be? And probably if I had time, I would ask you to kind of put this in the slide, but we won't do it. Now, got to be careful. See, it asks what his refund would be. Why is he getting $5,000? Because this is a fully refundable credit. It offset his liability, meaning brought that $4,000 down to zero, and then the rest was refunded to him. Okay. One more practice, and then I think we'll break here. Jose and Yolanda are married filing joint. They got 5 dependent kids under the age of 17, could say even under 18 there. Jose and Yolanda both have valid Social Security numbers, and their children have individual taxpayer identification numbers. Ooh. Are their children qualifying children for purpose of the child tax credit? No, why not? I'll back up. Why not? And I hope you're all saying to yourself, because the kids have ITINs, they don't have Social Security numbers. So, okay. There's a few more on child tax credits before we get into the family leave, and I'm going to ask Jean to pick up and carry those, just so we kind of take a break.
He hasn't napped in like over a year, and this is great. So thank you. Yeah, bye-bye. Bye-bye.
Yeah, I think she forgot to mute herself. Okay, good.
I have a quick question.
Yes.
When
Stephanie.
you stated about the care credit for a non-custodial parent, what form did that person have to sign, the one that was divorced?
Okay.
What was the form number?
Let's not mix up two things at once, okay? Because the one you're thinking about to release your claim to the dependent care credit, and that's for the child tax credit, it's a form 8332. It's a release of exemption, they call it. Okay, but then you asked about the child and dependent care credit. And remember, even though you release the exemption, only the custodial parent can claim the dependent and care credit. Now, the non-custodial parent, if they get the release of exemption and they get to claim this credit, the child tax credit, this one, they're not the custodial parent, so they cannot claim the child tax credit. But then let me answer your question directly. You said what form was it? It's the form 8332 is the release of exemption, and then the child and dependent care credit is claimed on form 2441. Let's see what else we've got in here.
The form 2141 is called a what?
Okay.
Care?
2441 is the child and dependent care credit.
Child and dependent care
Yeah.
credit. Okay, thank you.
Yeah. So I think Jean did it. It's 2:35 right now. So come back in 15 minutes at 10 minutes till 3 and we'll wrap up the day. Okay. Connie is asking me, can you explain who gets to take the child tax credit? So, and I know this is confusing, and I'm going to go ahead and do this. Everybody who understands this, go ahead and take a break. Connie, if you don't mind hanging out, I'll explain this a little better. Part of what's making it confusing is there's separate credits that kind of sound the same. There's a child and dependent care credit. And even though it has child, think of that as daycare. Okay, it's caring for somebody while you go to work. The one we're talking about is the child tax credit, and it's just a credit for being a kid. Okay. The rule with the child tax credit is they have to be claimed as a dependent on your return. And sometimes with divorced parents, you give up the claim, they call it the exemption claim. But for purpose of this conversation, let's call it the dependency claim. So maybe the divorce decree says, okay, husband gets to claim in the even years and the wife gets to claim in the odd years. But the husband is the custodial parent. The kids live with the husband, except for maybe visitation things, right? The husband, by the court decree, signs a form, and this form is called 8332, and he gives it to the wife. And so for those even years, the wife gets to claim the dependency for the child, and she also gets to claim the child tax credit. I hope I said that right. I should look at the rules.
But you said you had to be the custodial parent, and she is not a custodial parent.
Okay, but for the child tax credit, you don't have to be the custodial parent. For the child independent care credit, you do have to be the custodial parent.
And what if they split custody 50-50?
There's always going to be, well, okay. That's where you go to the tiebreaker rules. And if you look in the 4012 under the dependency thing about who gets to claim as a dependent, there's going to be another chart there that says tiebreaker rules. And there's where you get into adjusted gross incomes and things like that. Usually it's one or the other though, Beth, I will tell you.